After kind of a historic day yesterday, kind of a really crazy day in terms of very different, divergent performances, kind of went back to where everything just did the same, which is kind of typical, more of a typical bullish day. In fact, it probably would have been better if today was what we got out of yesterday's move instead of what we did get yesterday, where it was so extreme on one hand, and then, like I said, very divergent when you look at the Magnificent Seven. Regardless, we'll take a look at how things perform, how we finish the week, with the idea of how we expect to go into next week. Next week is going to be a really important week, especially for the Russell 2000. We've seen a move like this before in the Russell 2000, and we want to avoid that scenario again. So I'm going to show you that scenario. We've talked about it quite a bit, actually, but I'm going to remind you about it, show you that scenario again, and show again why next week is so important to build upon what happened here with the breakout in that particular index this week. We'll talk about the rotation or the rotation that's going into small cap stocks right now, how significant that is, and whether we really want that or not. We'll break that down. We'll take a look at how sectors are performed this week, kind of surprising sectors that are outperforming based off of what you would expect in a good, strong, bullish week. And then finally, our trade idea of the day is a stock that broke out like the Russell. And again, we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, July the 12th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter, for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. You can see our Market Outlook tweet here. Click that heart. It opens up that tab. Hit that like button. Same thing here with this. Click that tab. Here. Hit that like button. Again, the more you do that, it helps get our content out to our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. We can get to our 100 like goal on the Market Outlook's tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line is strongly bullish, remains well above the 90th percentile still, despite a little decline, very little decline. The near-term line went from being above 80 in 2 days to being only below 40. So that's actually a good sign for a bullish near-term low point to form. So very likely we come right back out of this. Back into bullish territory, and ideally back in 2 days it needs to be back to the 80th percentile. Otherwise, we're in danger of a bearish near-term high point to form. But the expectation is off of a bullish low, you would expect a bullish high to occur. So as of right now, we're doing okay, right? This is a really good opportunity going into next week for stocks to, again, it's not like we're coming off of a significant low point, so I wouldn't expect it to go up like 10% next week. But a good return nonetheless. You can see the weekly returns here for the past however many weeks. Here, let's go here. How many weeks it's been now? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks off of that April low point. This is what that April 15th low looks like. So it's like right this week right here basically is expiration week. So coming off of that low point, and we've had a pretty good run here of some weeks that were negative or flat, right? We had these 2 weeks were essentially flat, and 1 week where we were down 0.4%, but every other week, most weeks up at least 1%. This week getting really close to being up 1%, and only a couple of smaller ones. So really good run, and you can see these weeks started off. Even that week started off strong, but the first few weeks started the Monday off really strong. The Mondays have been getting gradually weaker, but at least the last 2 have been positive. And again, I would expect the next Monday to be positive as well, with the rally up to the upside here. If you take a look at the other indexes, the NASDAQ 100, which remember dropped the most, its near-term line fell more, so it dropped almost to the 20th percentile in 2 days, not quite. The momentum line bounced up out of the reversal zone, as we talked about last night. But didn't jump up very much. So there's, again, we got 2 days to get above 80 if it were to bounce back up immediately, because it doesn't start counting until you cross 40. That's your first day, right, when it crosses above 40. So assuming it jumps up on Monday, you've got by Tuesday to get above 80 for us to continue to be bullish. But again, we're not out of the realm of possibility. I mean, we're still in the bearish territory, and it can go lower. Most likely we'll bounce back up, kind of like we did off of this low point here. And you can see even when we were this low, 2 days later, you were at 82, right? So you went from 8 to 82 in 2 days, and it didn't take that big of a bullish move. So it doesn't have to like take off like a rocket. And in fact, if we did jump, we probably won't even. We might get to a slightly higher high by Tuesday than this high point here, if it were to bounce back up. We'll see. So we'll see here. Dow Jones Industrial Average. You can see the intermediate line now is in the reversal zone. Dark green shading and a green line. New highs. Not a new all-time closing high or a 52-week high. Because of the drop, we pinned ourselves exactly at 40,000. So how crazy is that? Over here on expiration, we got to 40,003. So not quite exact, but still same idea. Now that one, we ended up falling. By the time we were done, we fell 2,000 points from 40,000 to 38,000. So we'll see if we can get through 40,000 this go around and hold it this time. We did get a new 52-week high at the very least today at the highs of the day. And then finally, your Russell 2000. Big, strong move. All-time close, not all-time, but 52-week closing high. New intraday high as well. Intermediate lines crossed into bullish territory finally. The near-term line strongly bullish. Hasn't dropped very much at all. We did gap up today. A good chance that there's a common gap, but so far so good. I mean, we were looking for a big breakout move. What was it, on Wednesday's market outlook? Really, the first 3 days of the week, that market outlook. We kept talking about how the Russell was setting up for a strong breakout move. Well, here it is, right? This is that strong breakout move. Now, like we talked about last night, what we need is for it to hold, right? Because we've seen a breakout move like this before. If you take a look at the rate of change here over, 2 days. For the Russell 2000, it's 5.6% for 26 days. But if you look at just the last 2 days, now after a 3% run and a 1% run, we're almost at 5%. Right, almost at a 5% move. Well, I guess it would be, the 3 days. Let's go to that third day there. There we go. Almost 6% move over the course of these last 3 days with small gain going into the big breakout move. Again, if I were to zoom out here and go back to that late 2021 period where we also had a fake out to the upside right over here, fake out to the upside, you can see we also had a pretty strong 3-day move. Not quite as strong as now, about 1% lower. We're at 5.85, but still a very good and strong move, breaking out to new highs at the time, and then by expiration we were done. So that's kind of what we want to avoid. This go around, because remember, as I've said before, it's very, very familiar environment this go around compared to the end of 2021. Now let's take a look at the weekly market forecast since we are done with the week here. Again, continuing higher, there's that stretch of strong positive weeks. Like I said, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks now. So almost 3 months exactly to the end of this run. And again, 10 out of, for the SPX, 10 out of 12 weeks to the upside. And you almost ended up with a cluster, right? The momentum line came close. Probably if we would have closed at the highs of the day, it would have been different. But we almost ended up with a cluster there with the market sentiment line also above the 80th percentile. And again, well above the moving average in the 84th percentile. Not too far, but well above that level. So really good, strong move there. And you can see that as well, like in the NASDAQ 100. The Russell is the big mover, right? You can see the intermediate line is below 80. So we had the light pink shading, but now we turn back up. So we're back to dark green shading with a very strong weekly candle. Near-term line is not quite back above the intermediate line yet, but again, we expect that it will, considering that we were just below the 40th percentile. This would be 3 weeks ago, actually. So over here, we were below the 40th percentile. Then we jumped up above 40. So, but now it's been 3 weeks and we're still not quite above 80 yet. So we'll see how that turns out. You wouldn't expect, based off that. In fact, again, if we end up, you see, that was a 1 week breakout in 2021 as well, right? It was a good strong week. You got above all these highs, and then it faltered, right? So here we go, good strong week, got above all these highs, closing above all these highs, because that was 21.35. This was 21.26. We're at 21.48. So we're closing above all these highs of multiple, I mean, really going back months. We're closing above two new highs. So we didn't, over here, the highs were at, 2000. So, big multi-month year, not quite all-time highs, but pretty much multi-year highs on the Russell, breaking through. And now the question is whether, by next week, do we build on it or do we falter back down? So that was the problem at the end of 2021. And given an environment, there is a very strong possibility we get a similar pattern this go around. So next week is a very important week for the Russell, that we build on this and push higher. And I actually expect, I don't know if we'll have a same size week as what we had this week, but I expect it will be positive. We'll build on that. Let's look now at the other weekly charts. So you can see the Hakinyashu candle, very strongly bullish, very far above, the gap between the 10 and 40 week moving averages, very strong, 96 percentile. We are higher high, higher Hakinyashu close, looking great. Again, the Russell 2000 finished with a good strong weekly candle too, big long upper shadow there. Now, granted, that has in the past been a problem, right? You saw that there. You saw that in 2021. After a bunch of, you get this big candle with a long upper shadow, and we end up faltering, right? We end up faltering there, mainly because you get that long upper shadow because it doesn't go up gradually throughout the week. It goes up at the end of the week, so it makes the average harder to get from the open. So same thing is happening here. And again, you had, we did get a higher high. We did get a higher Hakinyashu close 1 week later, but then you're in transition mode 2 weeks later and the bearish 3 weeks later. And this is the scenario we want to avoid with this breakout that we're getting here. Let's look at the some of the three green arrow chart. So we'll start off with the three green arrows. Again, three green arrows across the board, very good, except for the NASDAQ. You did get one red arrow on the MACD, so you're in convergence mode. Remember, it was a little bit weaker there, so you are in convergence mode there. Let's take a look quick here at the two-line version, and you can see, again, on the Qs, the red arrow on the MACD, and you're back above the 8-day moving average, but not by much, right? So you're still kind of struggling there, and you can kind of see SPY, again, just, grinding higher, which is good. IWM, different story. Big breakout above the point of the value area. MACD is strongly bullish. Stochastics, big volume the last 2 days. Good breakout move that we just been kind of waiting for. Again, zoom out here. There's the breakout move there we saw, again, with good volume, right? We had good volume on these days too. And we broke out, and then in 1 week, and so it needs to be more than just this 1 week, especially considering it's really only 2 days. So we need to build on that move. Here's your DMI for the S&P 500. The ADX is now up to 43, so about as high as it got over here. Obviously, it got all the way up to 50 on the last run, and that was even at the midway point. It kept going higher even after that, as the ADX moved all the way down to 25. Very, very extreme lows on the we're down to 7.7, so we're below 8. There, the lowest point we got over here was 7.05. So very extreme lows on that negative directional index. Again, IWM, good strong breakout there up to 47. That's a higher run, about as high as we got over here when we got this cluster. We had that 2-day move that eventually, again, a few weeks later, we were down, and we were flat multiple months later. In that case, though, your ADX was already pretty big. By the time we got to that point here, the ADX was below 10 for a good chunk of time. So when your negative indicator is not extremely low, in fact, for us to be at 47 on the positive and not be below 10 on the negative is just crazy. Crazy move. You can see some of the other times that we've been at similar levels on the negative index The positive index is barely above 30, not even above 35. So you see a big, just how quick that move was, how extreme it was, which is the problem because it's harder to support extreme moves. Well above the Ichimoku cloud for IWM. You do have an intermediate trend strength going now that fast on IWM, the, of course, mature trend on the S&P 500. The RSI and the CCI is still at very strong levels for the S&P, and now is at strong levels for the Russell. I mean, you're above 70. Just like that, you're above 70 in 2 days. Again, if I were to zoom out for that comparison to back over here, you also got above 70 very quickly. Now, you were right there, right around 50, and then you had a little bit of a breakout in the pullback, and boom, right above 200. And like I said, this last go around, you got above 300, which is the highest the CCI has ever been for the Russell. And then now you're still back down to 287, which is still an unbelievably high level. So very big, extreme move on IWM to get as bullish as it did, way outside the Bollinger Band. Again, 120, which is itself a very strong level. And then your momentum is really picking up fast. The band's now outside the Keltner channels with that first green dot there. Let's take a look at the intraday move. Whoops, the intraday move would be this one. For F, we did get a higher high, higher low. We did not close above yesterday's high. We were there for a good chunk of the day. We were going to close above yesterday's high, and then at the last, 30 minutes or so, we just dropped pretty sharply. We dropped from right around 563 to 559. Oh, relatively sharp, 560. It's about 3 points there, but still a pretty decent move into the close that we didn't really necessarily need. IWM did not have as big of a drop from it. Did get up to a higher point earlier in the day, but still got a new 4-week high point, and you can see the size of the range has gone from minuscule to pretty large in a matter of, again, just 2 days, and you got your bullish breakout pattern there as well. Looking at the volume in the trading range, above average volume again, above average trading range again. So we've had 3 days now where the volume in the trading ranges have really picked up. That's brought the ATR back up above 0.8, barely, but still, remember 0.8 is extreme. So being anywhere at or below 0.8 is extreme. We are at least back up above it now. Your volume hasn't quite picked up yet, hasn't been strong enough, but at least it's not too insane. Remember yesterday's move on IWM was an extreme amount of range when you included the gap. Extreme amount of range, a little bit below average here when you don't include the gap today, but when you do include it, 210.68 to the low of 212.66, so about 2 more points. So you're looking at 4.25 relative to 3 average, and then 50 million shares trading hands. So for some perspective on that, 4.25 at least. I mean, that would have been the type of move that would have been great to have yesterday, right? Because it's kind of on the chart here, strong, but at least it's on the chart. And 50 million is only a little bit off the charts compared to what we saw yesterday. So this would have been a better type of move than yesterday's move. It wouldn't be so extreme, but 2 days straight of big ranges, big volumes. Again, when these ranges and volumes start to move higher, that's generally not necessarily bullish. And again, it might be temporarily. As you can see here, the volumes picked up, and the ranges started to slowly grind higher too on that rally. And then, when they kept going up, the ATR and the volumes, we started to drop. So we don't necessarily want them to keep going up. We want them, now that we've gotten the breakout, to get back to very small ranges, very small, and just grind its way to the upside. Let's take a look at the VIX now. So give me 1 second to take a look at the VIX here. Ended up today positive, but we had dropped sharply, down 3.5%, staying at the 85% mark. The VVIX dropped, but still above 80. So not a huge drop on the VIX. And if you look at where the VIX is relative to its average values here. So let me get to the average values. You can see we're still right around, the 8-day average and the 30-day average and 50-day average. And, we haven't broken up. We haven't broken down either. We're just we'll probably end up staying around here for a while until we get a breakout. Because we're not going to break down. We're too low to break down. But there's a good chance, obviously that we'd break up, and until we do, we'll probably just mostly just go sideways here. No extremes one way or the other. All right, now let's talk about what's driving the price action. You can see over the last 3 months, IWM has made a considerable move, obviously, in the last 2 days. But it basically, at one point in time, well, let's just go back to 2 days ago. So we will flip this back to July 10th, and then we'll go out to April 10th. So we'll have 3 months. Let's go to a daily chart. So just 2 days ago, before the big jump on IWM, so there's IWM right there. IWM was down 1.5% over that 3-month period. The Qs were up 13%. So now, fast forward 3 months later, so we'll go to a 3-month chart. IWM is now up 5%, and the Qs are up 11%. So it's still, the Qs are still outpacing them by twice the return. It's just not 4 or 5 times the return as it was previous, or actually more than that because it was negative. So a big jump higher in a very oversold asset class, and you could pretty much say that that's kind of what this move was. It was a jump higher in an extremely oversold asset class. Now, it wasn't oversold on an absolute basis. It was just oversold on a relative basis. Well, here, let me put IWM in the first, and you can kind of see how oversold it is, right? So, it's extremely oversold on a long-term basis and even on a relatively short-term basis, and it bounced up, right? We were so far below. If you look at where we were below compared to the 30-day moving average. Here, let's just go to a 5-year. We were pretty far below, right? We had made a big move to the downside, and now we're not, right? Now it jumped up. So that's really this isn't a great rotation into small cap stocks or into industrial. So if you follow me on Twitter, I put out plenty of charts that talk about there is no such thing as a great rotation, right? We if anything, when yields fall, the Mag 7 stocks still, those types of stocks, the large cap stocks, they still outperform. They're just joined now, not by the other cyclical areas like industrials and financials. They still underperform the markets. They're joined instead by utilities, real estate, and staples, right? The interest rate sensitive areas that are also traditionally safety trades. So it's not what you think. There is no great rotation because even though utilities and real estate are outperforming, they're still lagging in the market. They're still lagging behind, your large cap names traditionally, right? Whenever you've had these soft landing periods where yields fall, like for an example, the last soft landing period that we had, when yields fall, but we don't have an inverted, rising yield curve, was right here. So you can see right about, again, I think I talked about this the other day. It looks like we peaked right there in February. So by the end of February through the end of October, we had falling yields. And again, they ramped up by the end of the year, and then they really started to fall because of COVID. But that was really the extent of this move, where the yield curve was at 0.21, and by the end of October it was at 0.17. So it had gone up, it had gone down, it had rebounded. It was pretty flat. That's the ideal scenario. That is a soft landing scenario. Yields drop, and we don't get an increase, a rise that is the hard landing. We saw that with COVID. We saw that over here. This is actually more traditional because COVID was a very minimal recession. It really wasn't a bear market, right? It's just a correction in the stock market. But this is more traditional, right? Where you get the drop, the increase, the jump higher because rates are falling, and then you get a jump higher, the last leg higher because interest rates are rising, coming off those lows. So you don't really get the peak in the yield curve until well after the recession's over, until well after you've come up off of the bear market low point, like even up to a year in this case, off the bear market lows by the time the yield spread finally peaked. Because even though short-term rates were down, long-term rates kept going up. And you can see yields are starting to come down a little bit, but we had a period of time last year where yields dropped too, and they didn't keep going down. They stayed, like you can see, this whole entire time that we had these successive drops on the long-term rates, your short-term rates stayed flat, right? The 3-month and the 6 months, they're still staying flat. And you're getting a little bit of a decline now that the rate hike odds are up to very strong levels here for September, up to where are we at now? Up to 95%. Right, so we have a 95%, almost 95% odds of a rate cut in September. So big drop, right? So we're dropped. This is now. Yesterday it was at 7. Now it's at 5. So high probability of the rate cut coming in September. So as that continues, we should start to see the 3-month start to price that in. And it didn't really today. It had a pretty big jump yesterday. But remember the gap between 5 and 5.25 is 12.5. So that's about where the 3 months should start to move towards. We're actually still in the midpoint between 5.25 and 5.5, a little bit less, because that midpoint is here. It's 537.5 is where that midpoint is. So we've been a little bit above it, we've been a little bit below it now, but this is the midpoint where we're at, and you notice it hasn't changed all year, and a little bit of a breakdown, but it's got to break down a lot more than that before we start, as the market starts to actually price in more than these long-term rates. These long-term rates have been trying to price in a rate cut forever, right? I mean, we tried to price a rate cut in over here, we didn't get it, and we rallied back up. We've seen this a lot, right? A lot of times we've had dips here for the Fed to be done cutting rates, or raising rates, in 2023. And they were done in July. Like, we did get one more in July. But they had priced in being done a lot earlier, multiple times over here in this instance. And we're looking for rate cuts here at the end of the year. And then now again. But again, we still haven't got it yet. So we're still not really pricing that in yet as much as, especially like even the 10-year. The 10-year is really trying to price that in. And it, again, can't quite get there. And the 3-month just isn't. This is the biggest drop. We did have a pretty decent drop at the end of last year, only to rebound right back up to that, past the 537.5 level. So again, we're not necessarily the bond market. The stock market's definitely pricing it in. The long-term end of the bond market, as I mentioned here, it's been trying to price it in after multiple attempts here at the end of 22 to stop raising rates, and here at the end of 23 to actually start cutting rates. So multiple attempts to price that in, and the short end is like, we know better, right? We know better than what's going on, and you're still seeing that so far, right? We'll see. It remains to be seen again. By September of 2000, and right there, by September of 2007, so it'd be right. And so I can't quite get on that yellow line there, but you can see the short end was already falling going into that first cut. So they're not going to wait for the cut before it starts falling. It's going to start pricing it in early, and we're only 2 meetings away, so it should start pricing it in now. Right? We should start breaking that, which means that bonds should be relatively bullish. I think. TLT, like, it won't go up a lot. This is the very long end of the curve. Yeah, I don't think we're heading into a rate cut cycle. We better hope we're not, because we don't want that yield curve to steepen. So we're not going to go into a big extended rate cut cycle. We're just going to get, as of right now, maybe 1 or 2, and that's it. Well, let's see. Let's see what the futures market is pricing in. The future market still is pricing in a 95% chance of 2, and then a 55% chance for a third. But if I were to go out to, like, say, next June, we're looking at, again, 100% chance for 2, because we're at 5.25, 5.5 right now. So that would be 1. This would be 2. A 99% chance for 3. A 95% chance for 4. So you're looking at 100 basis points of cuts by next June at a 95% clip. And then you're looking at about an 80% chance for 5 cuts by next June. So that would be, these 2, and then within these 4 meetings, a combination of 3 more. So whether it's March, April, June, or however they end up, if they start off with September, December, March, and then start going April and June, you got an 80% chance of 5 cuts within 1, 2, 3, 4, 5, 6, 7 meetings. So only 2 meetings without a cut. So it does look like a cycle. We don't want a cycle, right? We don't want the yield curve to steepen. That's the last thing we really want to see, is this to happen. We don't want that. We want it to actually stay here. It can't go down because it's already inverted, and it can go down, right? But it probably won't go back to 100 basis points because that in and of itself was already pretty extreme. That was a pretty extreme level there, as you can see, compared to the late 70s, early 80s. So it's already 50 basis points in and of itself is pretty extreme. So you're already kind of there. So it probably won't go down a lot. Most likely will go up, but we just don't want it to go up a lot. We want it to stay in this area, just like it kind of did in the 90s, where it went up a little bit and just stayed in that area. But it had room to go back down before it was inverted. We don't have that luxury right now, so that's the difference. But that's the soft landing scenario. Bring rates down, but don't steepen the curve, right? Don't steepen the curve. That's what happens when you get lots of rate cuts. And that's the problem with pricing in 5 and 7 meetings, or when you go out to September of next year, you're looking at, again, 5. You're at 5 and a 5 and a quarter, 5.5 would be 1. 5 to 5.25 would be 2. So you have a 100% chance essentially for 4. You have a 95% chance for 5. You have an 84% chance for 6. And then, of course, you have about a 50-50 chance for a 7. So you're looking at 6 cuts by year, within the next year. Again, 1, 2, 3, 4, 5, 6, 7, 8, 9. 6 cuts in 9 meetings. That would probably be too many. I'm thinking maybe 2. Maybe a third is all you'd want to see. Because remember, cuts are inflationary too. So once the Fed does start cutting, you're going to see the CPI take off again. Commodities will take off. That's what they do, right? That's what happens. So you're going to see that inflation kind of ramp back up again. And, it's one thing to ramp back up like it did in 2019. If we were to go out to the Fed here, it's one thing to ramp back up when, not that one, that's the core rate. Let's go to here and we'll go to the year over year. And let's go to 2019. So here's 2019. So it's one thing to ramp up when you're below 2%, and we ramp up after those cuts to get all the way up to 2.5%. Big whoopity-doo, right? So there was a ramp up there when you start cutting, and so that's okay. But we're not at 2. We're already at a pretty high level as it is at 3. We don't want to ramp up from here. Like if we ramp up to 5, which you would expect with that kind of move, with how high we are. If we ramp, say over here in 2007, we started cutting right here in August. We had September was our first cut, so this would be the end of August. Like it ramped up from below 2.5, below 2, it got all the way up to 5, 5.5. So that's, and shoot, it went almost immediately up to 4.25, 4.33. So rate cuts are inflationary. They'll bring that inflationary up. We would like to be a lot lower, like in this area, before we start to raise it back up again, especially if it's only, again, 2 or 3, we're okay. We get 6 and 9 months, then you're going to get a ramp back up towards 5%. And then what will that do, right? So that's kind of the problem. That's the conundrum that the Fed has right now, and really the market has as well. Let's take a look at how the sectors performed here throughout the week. So let's just zoom out to the beginning of the week. And you can see the biggest outperformers this week, mainly in the last 2 days, were utilities and real estate. Those are your big winners. Utilities and real estate are your big winners. Communication services really declined big time yesterday and kind of held those. XLK bounced back up more. Still finished the week with a gain, though it was underperformer with the markets. And then you can see materials, industrials, financials. I mean, all these sectors that everybody wants to rotate into, which you can rotate into when you have these kind of short-term declines. Short-term declines here. Here, let's go back to the traditional cues. So when you're technically oversold, like IWM was, there will be a short-term rotation. But if we get a long, so you see, it's positively correlated with SPX. If we end up with a long-term rotation, with how strong that correlation is, again, if we break the 200-day, like getting down to the 50, that's okay, right? That we can still be bullish, as you saw. We can still be bullish, but we generally don't ever have, outside of a reopening trade, an economic reopening trade from a shutdown, we generally don't have strong bullish markets where those lead the way higher. Not in the current market environment where there's such a disparity between the sector weightings, where the sector weightings of XLK, Y, and C are so high. I mean, as it stands, XLK makes up a full third of the S&P 500. XLK does right here, a full third, so it's 33.36. And then you have consumer cyclical, which is your discretionary, up another 10%. And then your communication services are another 9 1/3. So those three sectors make up half the market. XLK, XLY, more than half, and XLC. So these other areas that are kind of the other cyclical areas, materials, energy, industrials, and financials, they make up a quarter. So though, they, in this current market environment, they won't lead a major market move to the upside. So there won't be a rotation into a smaller portion. They will only lead when the market itself is in pullback mode, right? Correction. So that's the rotation. And so everybody who talks about a great rotation in those areas, they're kind of rooting for a correction. And I don't think anybody really is rooting for a correction right now. All right. So now let's take a look at the breadth. So the nice thing about that is the breadth really took off. I mean, you got up to 69 here on the McClellan oscillator. The number of stocks above the 50-day moving average maintained itself above 300. In fact, it got above 350. That's 70%, right? So now we're at 70% mark. That's very good. Very, very bullish, very strong. The number of stocks above the 200 jumped up, also above 350. So it's at 75% here because it's at 375. So very, very good breadth, right? You can see the new highs and new lows. We saw that yesterday jump up to 500. Well, it stayed there. So very strong move up to almost 600. And then your skew, which is kind of measuring the risk. Like yesterday, the skew was insane. It got up to, where did it get up to yesterday? 157 yesterday. And today it's still at 152. The average is almost at 150. The average is at 150. Again, the last time the averages get to 150, that's not a very good sign. 150 is a very high number for this is the demand for way out of the money puts. So in other words, the demand to cover fat tail risks, big moves, not just your typical pullbacks, but big pullbacks, like big correction type moves to the downside. So we're seeing some strong demand for protection right now. And that takes us to our trade idea of the day. Let's take a look at Square. So Square is really kind of breaking out here on its own. It has been in the bearish trend for the past few expiration cycles, few months, and now it's turned bullish. Strong near-term move to the upside. Strongest move in quite a while here on the near-term line. The intermediate line is crossed above market sentiment a while ago, but now is crossing the bullish territory for the first time. You are dark green shading in the green line. We're 7% above the moving average, which is only the 57th percentile. So really good looking chart there. When you look at its weekly chart, you can see you got a green arrow. We're in a death cross environment. That's how bearish we were, but PPO is starting to rise. We have obviously a bullish candle, and you're flirting with breaking above both the 10 and 40 week exponential moving averages. You have 3 green arrows on the stock. We've been kind of flirting up and down. Ended up with a red arrow by the end of the day today. We came off the highs by the end. But still, you're right around that 3 green arrow mode. And stochastics is still pretty darn weak. If you look at the 2-line version of this, the stochastics is actually still above its moving average. Barely, but it's above its moving average. So it's a little different from that perspective. Again, good volume. Breaking above the 50-day moving average today, pulling away from the point of control. So that's a good sign for the stock. If you look at its DMI, you can see that we have dark green shading in the green line. We're above 30 on the negative indicator, or positive indicator, excuse me. We're below 20 on the negative. The ADX is starting to rise as a result. So a good breakout pattern there. There's a good breakout pattern here as well. You're above 60 on the RSI. You're above 100 easily above 200 on the CCI. So a good move there. The Ichimoku cloud, you're into the cloud now. You had been below it, but now we're into the cloud there. You have a positive rate of change. The green line's above the blue line. We haven't even started the trend. That's how early on we might be here in this cycle. And then finally, let's look at the Bollinger Bands and the Keltner channel. There we go, right there. And you can see that it's looking pretty good. Above the upper band. Was above the upper Keltner channel for most of the day today. A little late pullback. The band width is really low, still below the prior 150-day lows. So it's still got lots of room potentially to really kind of make this squeeze play and go up to the upside. So what I decided to do was to look at the to do a long call vertical spread. Here we go. Look at it over here. Do a long call vertical spread. So we'll sell the 80 low 20 deltas, buy the 77.5. You can see a trade from our class portfolio. So let's just take a look at just the trade here. So we'll look at the 80, the 77.5. Here's a better way to look at it. So there's the trade I did, selling the 80, buying the 77.5. You got a 51 cent credit. It's we're up. It's a 4-to-1 reward to risk ratio. That's a very aggressive trade, very speculative trade, but it's got some flexibility built in, so it doesn't have to move up immediately. But like I said, there's a good chance considering the type of trade, the type of breakout trade that we're getting right now. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.